Well, good day, everyone, and welcome to our FS Club webinar here on Monday, the 7th of September. It's a little bit later than our usual time at 5 o'clock, and for the very good reason that we have an extremely special guest with us, Corey Rosen, coming in from Northern California. Corey, we'll come on to in a minute, is going to talk about employee ownership and the future of capitalism. Those of you out there will know I'm Michael Mainelli. I'm one of the directors of Zien, and it really is my privilege to be able to introduce and chair portions of these series. One of the reasons I think that they're absolutely fantastic is the generosity of our sponsors, who allow us to range widely and freely across a whole variety of subjects to do with technology, economics, and finance, very often with the social purpose. And today is very, very much about a social purpose. It's not just the FS Club sponsors, but also the ESOP Center sponsors who really push things that are very, very important for society. And in this case, it is employee ownership. Now, many of you will be familiar, of course, locally here in the United Kingdom with Malcolm Hurston, who's set up the ESOP Center back in the early 1980s. But he did so in many ways hand in hand with Corey Rosen over at the National Center for Employee Ownership in the United States. And Corey has done a tremendous amount of work helping not just Malcolm, but also our government understand the important distinctions between the US and the UK, but also the important similarities. Now, for us here at FS Club, employee ownership is part of an entire scheme of things directed at a variety of the social development goals, but I would pick in particular SDG 10 about raising equality amongst people. And Corey's going to be talking to us as well about how does this affect the future of capitalism. Now, Corey's details are very much on the site, and you can go and look at them. The slides are already up in the handout area. Slides are already up on the web pages. So do feel free to browse, and that's why we save time by, sadly, Corey, giving you about that amount of an introduction, I'm afraid. My job, of course, is to get out of your way, so I've had my 3 minutes, and Corey's now going to talk for about 20 to 25 minutes, and then we're going to preserve enough time for questions. So I'm just going to give Corey control of things. Corey, the floor is yours.
Thank you so much. I really appreciate the opportunity, Michael, and thanks to everybody who's logged in at this late time for you, early time for me. So I appreciate your accommodating that. And right.
The other direction, Corey. Thank you.
Perfect. So my name's, let me go back to that slide there. My name's Corey Rosen, and I'm the founder of the National Center for Employee Ownership. You can see my contact information there. You have these slides. So I really encourage you, when you have questions or you're interested or you just want to chat about ideas about this, to get in touch with me by email. It'll be the easiest way given the time difference, but we can set up a time to talk if you like. Just briefly, the National Center for Employee Ownership was established 40 years ago now in my basement in Arlington, Virginia. We're now in the San Francisco Bay Area. We are a research, information, and outreach organization focusing on all forms of broad-based employee ownership. We have 14 staff and about 3,300 members. And at the end of these slides, you'll see some resources to explore this further. But if you go to our website at nceo.org, you'll see a lot more information about this topic in the US. So why has this been a passion for me for the last 40 years? I stopped being director 10 years ago almost now, and became essentially a full-time volunteer. And I'm still having a ball doing this because it's something that really, really speaks to me, and I hope will speak to you. So I know these sorts of data are specific to the US, and they may not be quite as pronounced in Western Europe and the UK, but they're definitely moving in this direction everywhere in the world. So in the US, just over 20% of Americans have no wealth at all. 40% can't cover a financial emergency with available cash, so say $400, $500. Half the working age population in the US has no retirement savings of any kind. When we look at the equity issues here across demographic characteristics, the typical white family has 10 times the wealth of a black family. 60% of white families have retirement accounts, 30% of black families. Median stock ownership by white families nearly 8 times as high. And these disparities, while less stark for other ethnic groups, particularly Hispanic groups, aren't quite as dramatic. They're very, very large. And so whether we're dealing with issues of demographic equity or we're dealing with issues of wealth insecurity, we need to find ways that address these issues, but we need to find ways that are practical. So the right and the left have all sorts of solutions to these problems that the other side couldn't possibly agree on. And so they become talking points, or increasingly in this country at least, yelling points for the two sides to attack one another with really no serious intent of ever becoming law. In fact, I often get the sense that the most strongly held ideological views of people, that those people would prefer to be right than to be effective. What employee ownership does is it combines being right with being effective with being practical. Because here in the US, and I know this is true in the UK as well, the concept of broad-based employee ownership is cross-partisan. Republicans, Democrats, in your country, all the parties have at one point or another strongly endorsed the concept of broad-based employee ownership. So it's an idea that can work. The question is how to make it work best. Having trouble getting this to move down. Let's see if we do it this way. Okay. So wealth insecurity is really debilitating. The lack of access to wealth is economically, socially, and psychologically devastating. It means we have no options. So how do we deal with it? And these slides, I think probably because of the time difference here, that the slides take a long time to move down. It may be better to pass the control back to you, Michael.
Okay, that'll be fine. I'll just take the next slide. Give me just a moment here. No trouble. Great.
So you can see this slide will be coming up here that, as I said, capitalism through employee ownership is something that both the left and the right have endorsed.
Great. So where you'd like to be, Corey?
Okay, great. Terrific. That's better. So how do we know that this idea actually works? And there's been in the US and to some extent in the UK quite a bit of research on this. In the US, the most common form of employee ownership is called the Employee Stock Ownership Plan. And we'll talk in more detail about how these ESOPs work. There are other forms of employee ownership as well, but ESOPs are the most common. And what an employee ownership plan is a kind of trust that the company sets up and funds. It's not funded by the employee, it's funded by the employer. We'll go into those details later, but let's just see how these ESOPs have worked. So what the research shows is that participants in these plans accumulate about 2.2 times the retirement assets of employees in other retirement plans in the US. And given that half the workforce is in no private retirement plan at all, they literally have infinitely more than the median employee, or half the rest of the workforce. We found, looking at a study done by the Bureau of the Census in the US, that the median household net worth for people who are in ESOPs is 92% higher. And if you look at people of color, 79% higher. Not only that, but employees in these plans are 1/3 to 1/4 as likely to be laid off, depending on the survey year. And companies that have these plans that take out loans to fund them default at the rate of 2 per 1,000 per year, so almost none. You can go to the next slide. And when we look at corporate data, we find that companies with ESOPs grow about 2.5% per year faster than companies without them. And it is that ability to grow faster that allows them to benefit employees more effectively. Now, while ESOPs are the most common form in the US, there are about 6,000 privately held companies, companies not on stock exchanges, that have ESOPs, and about 700 traded companies with about 14 million participants altogether. A number of companies grant equity to most or all employees. We think that probably in the range of 7 to 8 million employees are in companies that have these kinds of plans where everybody gets, for instance, stock options or restricted stock. And looking at those companies before and after they set up a plan and indexing out industry effects shows that productivity went up 14.8% and return on assets 2.5%. If you're interested in this, click on this link and you'll see all the major studies on employee ownership, corporate performance, and employee well-being. So looking at ESOPs, that gives you some idea of the scope of ESOPs in the US. I should say they were started in 1974. What was happening in 1974 was we were reforming our retirement plan law. And this idea of ESOPs had actually been around since the late 50s. It was created by a San Francisco investment banker and attorney named Louis Kelso. And Kelso said, as we go through the next couple of generations, wages will stagnate and returns to capital soar. Economists thought that this was totally cranky, that there was no way that would happen. It had never happened before, a disconnect between capital asset growth and wage growth. But in fact, Kelso was right. In fact, since 1974, median wages in the US, and I think this is also true in Europe, have basically been stagnant, whereas returns to capital have gone up about 8 to 10% per year in real dollars. The Dow Jones average had 3 digits in 1974, and of course now it has 5. So Kelso said we need to find a way for employees to participate in that capital growth. And the way to do that is for companies to set up these internal trusts that would hold stock for employees that the company would purchase on their behalf, and that there would be certain tax advantages to doing that. Well, when we were reforming retirement plan law, an opportunity came up to fit the Kelso's idea into that structure of private retirement plan rules. The fit isn't perfect. It's somewhat awkward in some ways, but because that was the train leaving the station legislatively, it was convenient to tack that on. So why do companies do ESOPs? The vast majority of companies in the US who do it are closely held companies where the owner is looking for a business transition, and they could sell to private equity maybe, or they could sell to a competitor. But if they do any of those things, then the legacy that they've built in their company may vanish. The company's employees may not continue to have jobs. So things will change a lot. And their role in the company no longer is going to be something that they choose, but something that's chosen for them. Whereas with an ESOP, they can exit the business in a very flexible way and retain the legacy that they've worked so hard to build. What makes this practical is that the rules for ESOP allows the company to use pre-tax dollars, so tax-deductible dollars, to make contributions to the plan to buy the stock. ESOPs can buy some or all of the stock from one or more owner, and they can improve competitiveness. S corporations, which is a certain kind of corporation in the US that have ESOPs, get tremendous tax benefits on top of this. So you can see some of the basic rules here. All full-time employees must be in the ESOP, and once you're in the ESOP, you get allocations of shares. These are subject to service and vesting rules, so you have to generally work at least a year, and you would vest over the next up to 6 years. When you leave the company, you get the shares that have been allocated to you, and you can sell them back to the company. All of these transactions are done at an appraised fair market value. So this is a big difference between the US model and the UK model. The US model, the employees actually get the value of the equity, whereas most EOTs in the UK, the employees are owners in a kind of nominal sense and have a right to some of the profits, but they don't get the increase in the value of the equity in the same way. Go to the next slide. So we're going to go through the mechanics here quickly. The company sets up a trust, contributes cash to buy shares, or if the company isn't interested in buying shares, it can just contribute shares, new shares, and take a deduction. Most often, because the owner wants to sell a big chunk, the owner has the company borrow money, and it can be through a bank, or the owner can take a seller note. That loan goes to the ESOP trust. The trust takes that money and it purchases the shares. The company then repays that loan with tax-deductible dollars up to a very high percentage of the payroll in the plan. So unlike a normal redemption, this is all done in pre-tax dollars. Continue. So it's paid at a fair market value based on what a willing financial buyer would pay. The ESOP can't pay a synergistic value. Go to the next slide. So when a company is valued, basically what the appraiser is doing is looking at future free cash flow, and they will multiply that, so some multiple derived out of a discount rate based on how different kinds of assets require different rates of return. So a closely held individual company requires a higher rate of return than, say, a diversified large public company or a mutual fund. So typically in the US, private companies are valued sometimes between 3 and 7 times free cash flow. Go to the next slide. Now there's significant benefits to the seller. So if I sell to an ESOP, I can defer capital gains tax on the sale. In the US, depending on the state you live, that's between 20 and 33% of the gain that you've made. And so if I sell to an ESOP, I can take that gain, reinvest it in other stocks and bonds of US companies, defer any tax until that's sold. If the company is what we call an S corporation, and I'm not going to go into details here, but most ESOPs either become that or they are that when they start, then the percentage of ownership attributable to the ESOP is not taxable. So if you become 100% ESOP, the company pays no tax at all. That's not a tax loophole. That's something Congress intended. And go to the next slide. And let's skip that one in the interest of time. So again, just reviewing the funding options. A bank note is the typical approach, payment over 5 to 7 years, but we're seeing a lot of sellers now take notes as well as a more flexible way to do the transaction. Plus, if you want to do 100% transaction all at once, which is increasingly common, banks aren't going to finance that all in one big chunk. So the bank will finance part of it and the seller will finance the rest. And next slide. So you can see here some of the typical seller notes structures here. The terms of the loan from the company to the ESOP don't necessarily match that to the seller. The internal loan to the ESOP is usually paid over a longer period of time. And the seller notes, as I said, are often used in combination with bank loans. And if you're interested in the warrants idea, you can let me know. I'll explain it to you. So when the trust borrows money, the funds go into the trust to purchase the shares. The trust takes them and buys the shares. Now the shares are put into what's called a suspense account. And as the loan gets repaid, the shares, whatever percentage of shares have been paid for, get released to employee accounts. So that's the basic structure. And I've got some visuals here that will show that coming up. So here we go. So you set up the ESOP trust, and you can review these at your leisure later, but you set up the trust. It's a retirement plan. Go to the next slide. Now the company contributes money to the trust, or as I said more often, the lender loans money to the trust. We can go to step 3. Using that money, buy some of the owner's shares. That's determined by an independent appraisal firm. That leads us to step 4, where now the trust has these shares and it starts allocating the shares to employee accounts. That's basically all employees who've worked for a year in the company, and those are subject to vesting gradually over up to 6 years. When the employees leave the company, they're cashed out. And for Pat, our owner, she found a buyer. She can keep working there and ease out in stages if that's what she wants to do and it works for the company. The employees get ownership, and hopefully everybody, and Pat gets some tax benefits, and hopefully everybody's happy. So key points, it's the company, not the employees, funding the plan. The acquisition of shares is a non-productive expense, so the company must be able to have the earnings to absorb it. And ESOPs are the only way a company can use pre-tax dollars to buy out an owner. And you can see here some of the vesting rules. You can read that slide later, but these are the basic rules about who's in the plan. And this explains when you get the distribution, employees don't have access to the shares while they're in the plan. But after they leave, on somewhat flexible terms, the employee pays them out, the employer pays them out, and it can do that over time. These distributions can be large. It's typical for an employee who's worked for an ESOP company for, say, 20 years to leave with an account balance in the range of $100,000 to $500,000. And this is for just ordinary working employees. So what about governance? These rules differ, I know, somewhat in the UK, but in the US, the trust is the legal owner. The trustees are appointed by the board, and employees have very limited voting rights. So governance in ESOP companies pretty much tracks governance the way it was before, unless the company wants to change. And that's not uncommon, but it's not required. They're expensive to set up, lots of lawyers and appraisers and trustees and so on. And that discourages some smaller companies, but the tax benefits really dwarf this. So it's really important to understand that sharing ownership's not enough, that just by setting up an ESOP, just by sharing equity widely with employees through some other mechanism, that in itself is not going to create improved corporate performance. The most effective companies, all the research shows, have some very specific characteristics. They share information at both the overall company level and through work level metrics. In other words, if I'm working for a company, say a manufacturing company or a service company, not only do I know how the company's income statement and balance sheet work, but I know what are the critical numbers for the particular work operation that I'm involved in. So if it's throughput, or if we're an engineering company, how much of the time is being billed, or customer satisfaction, or all these different numbers are tracked and regularly reviewed by employees in teams. And those teams then use this information to identify problems and make decisions relatively autonomously about issues affecting their jobs. And more ESOP companies are going beyond this to involve employees on a company-wide basis in generating ideas beyond just the particular work they do, but in some of the larger decisions that the company's making strategically. The companies that have this high involvement work management system with ESOPs grow about 8 to 11% per year faster than would have been expected if you didn't have that combination. And this is a very, very well elaborated and verified piece of data from multiple studies. Just briefly, I can show you a typical example of this in an employee-owned company. This is an employee-owned company in Michigan. So I'm an employee and I have an idea or a problem, because it's really important that if you know a problem, you should identify it even if you don't know the solution. That old thing about, well, if you don't know the solution, don't bother me with the problem, is pretty stupid. If the gas is leaking, you want somebody to tell you, even if they don't know how to turn it off. So at MSA, you can identify a problem or you can identify an opportunity, but you write it down, you put your name on it and your date, you explain why you think it's happening. And if you have an idea, then you put that idea down. Now, what happens next is MSA teams, and the whole company works through work teams. Everybody's on a team. They call them huddles. So these huddles will meet often weekly, and they've got an idea board. Well, here's all the ideas that have been submitted. Let's track these. Who's the owner? Who submitted it? Who's leading that task? What is it exactly we're trying to do, and when do we expect to finish it? So they have this to track and see how they're doing. Now, there's some parking lot ideas. Maybe these are interesting ideas that need some help or that aren't priority now. We can turn to those for the future. A company I'm on the board on in Texas, they created, and a lot of companies are doing this now, an opportunity for employees to meet virtually now. Everybody met virtually through a Zoom meeting. And they had a brainstorming session. So everybody was divided into Zoom rooms of about 8. And each room was to come up with things that they thought the company should be pursuing that it wasn't pursuing now. So opportunities for what I like to call the adjacent possible. The adjacent possible is that idea that's similar enough to what you're doing now that you can envision having the resources and capability to get into those markets, but not so dissimilar that it's such a leap that it's an enormous risk. And so they, with that sort of preface, let's think about adjacent possible ideas. This company got all these employees involved. Each group then submitted its top priority ideas. It might be 1, it might be 3 or 4. They all came back together. They reviewed all these top ideas over the next couple of hours. And as a group, they selected the top 5 to pursue. And now management has the charge of seeing if they can turn those ideas into business ideas. And to do that, once management said, boy, this is something we want to pursue, then a cross-functional team of employees at every level of the company will be created to do this. So the people actually going to do the work, the marketing, finance, and so on, there'll be a team representing people from all those areas to elaborate these ideas and make proposals. So if you're interested in learning more about employee ownership in the US, here are some additional resources. I did not talk about the companies that share equity through broad-based equity plans like stock options, and that's because what we do is not that dissimilar from what you do on those scores. But what we do on ESOPs is fairly different and has had a rather dramatic effect on workers here. So understanding ESOPs is kind of the basic book. If you're interested in these ideas about employee involvement, I wrote a book just this year called Beyond Engagement: How to Turn Your Company into an Idea Factory. And it's a series of precepts and stories from a variety of employee ownership companies worked out step by step so you can see how they do that. Really interesting companies and stories there. That's our website. And next week, we have our fall forum, which is virtual, of course. And you can, if you want to watch that live, you can. But if you register for it over the next, if you register it now, then you'll have access to the recordings over the next couple of months. And that's about 40 sessions that will be run during that fall forum. So,
well, thank you very much, Corey. And folks, the details of that fall forum are available on the website as well, or please contact Juliet at the ESOP Center. Wow, you really lit up the board, Corey.
And Juliet, I think you have a special offer, right, that we gave you for people.
That's right. There's a special UK offer. So Juliet can give you details if you want to go to that.
Super, super cheap.
Meanwhile, David Craddock points out all the tax-approved UK schemes deliver the capital growth value, David being one of our resident experts, so I'm sure you know well. But he then goes on to an interesting question. Corey, why is there such variation between the individual states within the US in their embrace of employee share ownership?
There is some variation. It's not that dramatic. The highest concentration of employee ownership relative to the population is in the upper Midwest. And it's probably because that area was settled by Scandinavians. And so a lot of that "I'm not better than you are" culture still pervades there. My daughter lives in Minnesota, and Minnesota nice is a thing we talk about here. It's sort of like Canadian nice, and it's a real thing. But the variations aren't that dramatic.
Okay. Graham Nuttall, whom I believe you also know, says, Corey, I trust all is well with you. Aren't we really only talking about timing differences between an EOT and ESOP when it comes to comparing rewards? In other words, it's the same surplus profits that are available to finance employee ownership. In an EOT, $10 might get paid as a bonus each year, and in ESOP, the same $10 is available to buy shares, including repurchasing shares from leavers. Your thoughts?
That's absolutely true. And I think it gets to an important point, which is that if my incentives are to increase profits this year, because then I'll get a bigger payout this year, that's a different incentive than if what we're trying to do is to grow the company long term. So that's one issue. How much that changes people's behavior, I'm a little skeptical that that's a big deal. What I'm not skeptical about is that ESOPs in effect become a kind of forced savings because you're not getting that money, and because that money is building up with no tax obligation to you, unlike a profit sharing plan, for instance. You're not going to spend that money on something now. It's going to accumulate, and that's how wealth develops. So it is a kind of forced savings, and as we've seen, it ends up with employees generating a lot of retirement income. But I think it's really important to understand this is not at the expense of employees not getting access to current income. Employees in ESOP companies actually are paid higher than employees in non-ESOP companies and are probably more likely to have profit sharing plans on top of it.
Okay. Bob McDowell is curious. He's wondering, really, are ESOPs protected from the challenges of Chapter 11 and other capital restructurings with that impact companies. Any quick thoughts on that?
ESOP companies fail like any other company. So sure, a company can go bankrupt. We do know from extensive data that ESOP companies are substantially less likely to go bankrupt than comparable non-ESOP companies, but they do. It happens.
Okay. Bob then touched on another point, which Nigel Mason has also picked up. For the past 40 years, there's been increasing mobility of labor, job move, relocation, gig economy. How can these sociological phenomena be reconciled with employee share ownership? And Nigel goes on, the workforce, especially the younger workforce, is becoming increasingly itinerant with part-time workers, 0 hours, etc. Does that mean that ESOPs are increasingly the preserve of middle-income, middle-aged workers? In other words, are ESOPs truly reaching those workers who need the capital accumulation opportunity the most?
Well, a couple of things on this. The gig economy certainly is growing. It's not as large as people think it is from the data that I've seen, but finding ways to include those employees in ownership, which right now there aren't a lot of ways that companies are thinking of doing that, is a really critical task, I think, for us that needs to be taken on. But for the rest of the workforce, at least in the US, it's actually a myth that job turnover and instability are higher now than they were even in the 50s. The rates of people turning over at work and of young people leaving work are not significantly different now than they were then. And if you look back at almost any point during that time, you'll see people saying, gee, younger people don't stay at work as much as they used to. They never used to stay at work very long. People in their 20s always change jobs while they're figuring out what they want to do with their life.
Yeah.
So the data actually don't support the idea that that phenomenon has changed.
Very good. Stephen Murgatroyd is curious, in the United States, are ESOPs welcomed by trades unions?
Well, the first thing you need to understand in the US is trade unions in the US have virtually disappeared in the private sector. I think it's about 7 or 8% of the private sector now is unionized. So for some of us, at least sadly, they're just not very relevant to this issue anymore. In the past, some unions really embraced it and some unions really opposed it. I would say today, most unions just don't care. They're struggling just to stay alive.
Well, wait till we have a government ESOP and then the trade unions will pay attention.
Yeah.
Okay. There's a lot of interest here on comparing the US and the UK, and I might just squeeze in 3 questions on that. First was, how fast is the ESOP movement growing in the United States? Number of companies, value?
So by one metric, the number of new plans, it's pretty much flatlined. So the number of terminations each year, for whatever reason, is roughly equal to the number of new plans. And the most common reason for termination is that a company gets an offer it can't refuse. I was on the board of a company that had 12 offers at over 2 times its current appraised value, and they would retain every employee. Well, it's hard to turn those down when that means that most of your workforce is going to be getting hundreds of thousands of dollars, plus keeping their jobs. So that's the most common reason, is that ESOPs are successful. But that number now sort of equilibrated. But 2 other measures present a very different picture. One is the number of participants in these plans has grown steadily by about 4 million employees over the last several years, to a decade, I suppose. And that's both because of internal growth, but also because of a phenomenon that started here about 10 years ago, whereas ESOP companies have matured, paid off their acquisition debt, they're 100% owned, they have no taxes. Many of these companies are doing lots of acquisitions. So there are more companies being acquired by ESOP companies each year than there are new ESOPs. So if you think of those acquired companies as effectively new ESOPs, then the number of new ESOPs is dramatically higher. There's one company here, a tree service company, that's done, I think, 120 acquisitions. There's an insurance agency in Texas that's planning on doing 40 to 45 acquisitions per year for the next few years. So this is something that's really driving growth.
That's probably an analogy I shouldn't be using in this era, but it's going viral in the sense of kind of coming in and being spread. Yes.
Yeah.
Yeah, Rob Rees-Jones, who asked that, I don't actually have the UK numbers to hand, but I believe we've been pretty flatlined here as well for a number of years. So interesting observations there. A nice way to look at that growth. Just to, again, back to these comparisons, and I know you've been over in the UK and you've met our ministers and sold, particularly when it was a cross-party, there was cross-party enthusiasm for this, some of the concepts, but I assume you probably then came across the John Lewis partnership model. And Stephen Murgatroyd is curious if you could comment on that model and how close it is to ESOPs, how far away, any pluses or minuses.
Yeah. Well, a couple of big differences. One is it's a permanent trust, so it can't be sold. ESOPs can be sold. I wish the rules for ESOPs were different on this so that employees had more ability to block a sale. Right now, even if the employees vote to block a sale, the Department of Labor may say that they can't, and that's because of the peculiarity of ESOPs being part of retirement law. I won't go into all the reasons, but that's the origin of that. Another big difference is John Lewis is based on sharing the profits more than sharing the future value. And the governance in the John Lewis partnership is much more extensive than it is in most US ESOPs, but certainly not all. So those are the big differences. The John Lewis partnership has been an admirable company and a really iconic company, obviously, in the UK, and I have a lot of admiration for what they've done. And Nigel, there are few companies like John Lewis in the US that have that same permanent trust model, but not many.
Nigel Mason's very kindly kicked in to point out to me that the UK numbers are that, yes, share schemes have flatlined, but EOTs are growing fast at about 35% per annum, albeit from a low base, which is which it was, but they're now over 400 of them. So thank you very much for pointing that out, Nigel. And two final questions at the time available. Susan Jones congratulates you on an excellent presentation, and she's dialing in from Los Angeles. What can the US learn from employee share plan practice in the UK?
I think that actually fits right in with the John Lewis example. That I think one of the most important things we can learn is to provide companies, at least with that option, to provide a permanent employee ownership model without having to lose all the tax benefits, which right now, that's what would have to happen. If you wanted to have that governance model, that permanent model for ownership, you couldn't be an ESOP. And I'd love to see that change if possible. Not a lot of political momentum around that one. The other is, the experience that you had in 2012, where this was like on the front page of the Financial Times for a while, this idea of a John Lewis economy. And we were very envious here that while we have extremely broad support for employee ownership, it's extremely shallow politically. Nobody opposes it, but it's not the top of almost anybody's agenda. And boy, would we love to see that discussion happen.
Okay. You did say the origins of this meant that the fit was a little bit awkward, but everything has to follow the political agenda at the time, doesn't it? Yeah. So oddly, this was the very first question in, and I hope Stephen Woodhouse, who presented it, doesn't mind me saving this to last, because I thought it'd be a good question to end on. The whole topic of this wasn't to get into tax details, but to compare and contrast and look at the future of capitalism. Stephen is curious, how important do you believe it is for the future of employee ownership for professional advisors to understand the underlying economic drivers?
I would say that is the single most important thing in the US for sure, the single most, when people say, gee, ESOPs have all those advantages, why aren't there more of them? And it's because the financial advisors who are the intermediaries to the people who would be setting up ESOPs, either don't know what it is, and there's a human tendency to say, if I don't understand it or I don't know what it is, that's because it's a bad idea. Because if it were a good idea, surely I would. I don't mean to be overly cynical. I think that's absolutely true. And that's a big problem. Second problem is for those people who have a little bit of understanding, they're often wrong. So what they think about ESOPs is they can only be done for certain industries, or the employees have to run the company, or the employees have to buy the shares. And they tell their clients that, and that's the end of that story. Or most insidiously, is that M&A advisors and business brokers have a disincentive to do ESOPs. Because if I can find you a buyer, then I'm going to charge you a percentage of the transaction. If I go to you and I say, well, I found a buyer, it's an ESOP. It's in your company. Do I pay you, if I'm a $10 million company, $250,000 for that piece of information that I could have found by going to nco.org for free?
Yeah.
So I've talked to these people who've told me, I know an ESOP is the best idea for my client, but it's not the best idea for me.
Great. Well, I'm afraid I'm getting a lot more comments congratulating you on an excellent presentation, which is always a sign that we have to draw it to a close, sadly, given the exigencies of time. I would like to, if I could, just to give out 3 words of thanks. First, as ever, to our sponsors, not just the FS Club sponsors, but also our ESOP Center sponsors. Thank you for allowing us to explore the world of technology, economics, and finance as we wish. And it's been great to bring in some of these wonderful, wonderful views from America. Remember as well that we have a tremendous number of resources available for everyone online over here too, and go to the website as well to click onto Corey's forum next week. Those of you who've been listening, you've been superb in getting in tune with the conversation, so thank you. Later this week, we're going to be taking a look in detail at the Turks and Caicos. We have a wonderful session from Brussels on regulation and recovery. What's the EU financial services, which has clearly got to be a hot topic for all of us. And then next week, we're looking at, can I really be an inventor if I work in finance? How many of us have thought about patents and where might they apply and not apply? And finally, a little bit of a change for us, but we're going to take a look at mindfulness next week as well. So stay tuned for all these things. But I think the most important thing for me, Corey, and sadly in this age of COVID, I'm unable to open up and give you the rapturous applause I'd like. But I have brought along my Korean karmic clapper so that I can give you a hearty thank you for that. You were absolutely super, and thanks so much, particularly on the Q&A session, being snappy and really giving us a great view of what's going on over America. There's still many things to learn on both sides of the water. Thank you.
Thank you, and thanks especially to all of you for coming. I know, hi Nigel, and thanks to everybody for coming. I really appreciate it.
Great. Well, that's great. So goodbye one and all, and we'll see you again soon.
Thank you all.